And then the other thing I think that really bears watching is Bitcoin, because I think there is a lot of policy that's being built around Bitcoin finally being more accepted. So I think there's a lot of cumulative tailwinds building for the financial sector at a time when the PE multiples there aren't that. Without question, the stock market would have a lot of pressure because it's hard to make the case that multiples can offset the earnings risk that this represents. So then markets could be correcting for a lot of 2025.
Could 2025 be the year of unprecedented market twists? Tom Lee shares his bold insights on Bitcoin's regulatory transformation, the return of animal spirits, and looming risks like tariffs and valuation bubbles. From mid-cap surges to Wall Street's influence on policymaking, this interview unveils a roadmap to navigating what could be a pivotal year. Stay tuned for some surprising predictions, equities in 2025, tailwinds and headwinds.
As we look forward to 2025, I think that the fundamental visibility is much better than it was at the start of 2024, meaning we have a Fed that's dovish, and I'd consider that, a Fed put. We have the election behind us, which was really a source of angst in 2024, and the incoming president is very pro-equities, so I'd call that a Trump put. That's a tailwind. We know businesses have been cautious for the last 2.5 years because of the combination of the pandemic and the repercussions on the labor force, plus the inflation wave, plus a Fed that was trying to quash inflation. So I think animal spirits return. So these are the tailwinds that are positive for equities in 2025. But the drawback in our view, or the headwinds that emerge, is one, there's a lot of promise about potential initiatives in 2025 that I think become, markets have to reckon with it. I think that comes in the second half. There is also a valuation. The stock market is more expensive than it was 2 years ago. So the markets may be a little less patient if there are any stumbling blocks. And the third risk, in the second half that emerges is that there are things that markets will start to worry about, like deficits and the potential ending of the business cycle in 2026. So I think that those are the things that weigh on markets in the second half. Yes, I think some of the initiatives have a lot of positive potential. Others carry with it risk. On the things that carry risk is how the economy will be affected by mass deportations if that happens. The notion of tariffs. Tariffs can be an important tool, but tariffs can be very disruptive to a global economy. And then there's also DOGE, the Department of Government Efficiency, that I think if we were in a crisis moment, DOGE could be extremely effective. But at the same time, tackling government spending is something that I think is extremely difficult and fraught with visibility risk. And I think it poses risks for companies that are big government contractors. So that's what we have to watch. And then the other thing I think that really bears watching is Bitcoin, because I think there is a lot of policy that's being built around Bitcoin finally being more accepted. The sandbox changing for Bitcoin to be something that the U.S. government potentially embraces. Our research sort of foundation, one of the keys is the idea that history serves as a really important guide. And what I've been struck by is that if I take the US versus the DAX, for instance, any more than 10-year period, the returns, the nominal returns between the DAX and the S&P should be very similar. And the starting point for non-US markets is a much lower valuation. And in 2025, if we're talking about animal spirits coming back because of central bank easing, and that's a cyclical upturn. Well, outside the US, there are many cyclical companies, industrials, financials, banks, exporters that should benefit. And so I'm not opposed to the idea that next year, if the S&P could essentially feel like it's treading water next year, could emerging markets do better? I think so. And, some things to watch are like China, because China is unleashing some stimulus. And if China's leading, I think it does mean the rest of the world does quite well.
Tom Lee breaks down the key forces shaping 2025's economic landscape. A dovish Fed, a pro-equities presidency, and pent-up business activity signal strong tailwinds for markets. Mid-caps, small-caps, and financials are poised for growth, with reduced regulations and a falling cost of capital-boosting confidence. However, the risks are just as real. Rising valuations, potential tariff wars, and concerns over deficits and economic cycles could weigh on markets. Lee also points out Bitcoin's shifting policy landscape as a game changer, with the U.S. government inching toward wider acceptance. Stick around to hear how these factors could reshape the global financial system.
I'm in the camp that next year it's less about the Mag 7. I think the Mag 7 will produce good earnings growth, and so that's going to support valuations not contracting for the Mag 7. But to me, the case for PE expansion and earnings surprise is coming more from the mid caps and the small caps. I mean, for instance, if the Fed remains dovish and the cost of capital actually starts to fall, that's going to benefit many cyclical companies. If there's less regulation and there's M&A, that's less a story about the Mag 7 benefiting, but it's really more about software and a lot of cyclical stocks leading it. Our number one sector pick next year is financials, actually, within the S&P. And then outside the S&P, I think Bitcoin and small caps actually outperform financials.
Why financials?
Financials play a pretty important role in the economy. They're essentially the other side of the ledger. So for every actual economic event, the financial system has to provide the accounting and markets mechanisms. And next year, we think that there is a lot of opportunity for the economy to see increased activity. Let's say the PMIs are finally turning up. ISM's been below 50 for almost 3 years. So it's been the longest industrial recession ever. As that turns up, that means companies become more confident and there's more expansion. Well, that's more financial activity. M&A activity has essentially fallen to multi-decade lows because of a tight Fed and concerns about a recession. As businesses have some pent-up demand and there may be some capital markets activity, well, that benefits financials. And when I look at regulation and the idea of less regulatory burden for companies, one of the industries most positively affected is financials. So I think there's a lot of cumulative tailwinds building for the financial sector at a time when the PE multiples there aren't that demanding. I know the stocks did very well this year, but I think they're going to do well next year. We took everything at face value, so these tariffs get implemented. And this triggers retaliatory tariffs from other countries. And then we have both a volumes effect, so the flow of goods globally starts to slow. So you have weaker growth, plus the actual realized price of goods goes up because U.S. consumers bear the cost of that tariff because these are the cost of imported goods. So you have optical inflation higher and then a weaker economy, which means joblessness goes up. And then without question, the stock market would have a lot of pressure because it's hard to make the case that multiples can offset the earnings risk that this represents. So then markets could be correcting for a lot of 2025. If the White House measures its success through how the stock market's performing, that would put enormous pressure on the White House to rethink whether these things are achieving their goal. Because if the White House wants to measure its success through the stock market doing well, I think they'd pretty quickly realize that a tariff war is not popular with Wall Street, even if it's something that as a policy sort of cornerstone, they want to make it as a policy cornerstone. That's just a supposition because, of course, I'm not a White House insider. So much of what anyone wants to accomplish in the economy or even as policy does require the cooperation of financial markets. And that's because, as you know, the Fed itself is quite afraid of the bond market. The Fed never really wants to make a policy shift that the bond market would be surprised at because then that could actually run counter to their goals. So that's why when the Fed's cutting and if yields start rising, the bond market's clearly sending a signal that they don't want too much easing. So there is an equilibrium that someone with Wall Street experience can appreciate. And I think I would counter that by, so many people think policy should be driven by economists. And I think one of the challenges over the last 3 years that I found as working with institutional investors is that over the last 3 years, so many of our institutional investor clients began to rely more and more on their economist to give them an idea of what the future looked like. And as you know, economists rarely can tell you what will likely happen. They can tell you the effects of what has already happened. And I think one of the things I'd be very worried about is someone trying to drive policy purely from an economics perspective. So I'd rather have someone with markets experience telling you that this is where markets could actually protest, and that's what can keep policy in check. One measure that, by the way, and this is a side note, is that the compensation of economists on Wall Street rose dramatically over the last 3 years because every hedge fund wanted to know how to parse and interpret the Fed and economic data. But a lot of these economists ended up providing insights that were forward-looking that proved to be very disastrous for many institutional investors.
Tom Lee's forecast highlights both opportunities and risks, making 2025 a year of high stakes. From the transformative power of Bitcoin to the dangers of tariffs and regulatory overreach, every investor should pay close attention. Will markets defy expectations, or will headwinds prove too strong? Share your thoughts below, and don't forget to subscribe for more deep dives into the world of finance.